Welcome, everyone, to the Alpha Omega Accounting Podcast. If you're joining us for the webinar today, thanks for logging in. I'm your host, Scott Knock. I'm a tax professional here at Alpha Omega Accounting, and I'm working my way toward my enrolled agent license. Joining me today is Cynthia Fingenbinder, the founder of Alpha Omega Accounting. She's a seasoned CPA who's been guiding nonprofits and small businesses to success for over 28 years, and also my mother. Hello, Mother dear.
Hello, Scott. I'm glad to be here.
We're here today to cover nonprofits and the pitfalls that they can find themselves in. In my studies and in my daily work, I see so many people who think starting nonprofit just means waving a magic wand and calling yourself a charity and never worrying about taxes again. But I'm learning it's a lot more complicated than that.
It is much more complicated, and that's exactly what we're diving into today. The goal here is simple. We want to help you catch compliance traps before they become actual problems.
So before I start grilling you with questions, we do have a quick housekeeping note. This information is for educational purposes only. Alpha Omega Accounting provides accounting services, but this should not be considered tax advice. You can schedule for specific tax questions. Also, this is not legal advice. Please consult an attorney for specific compliance laws that pertain to your organization and state. All right, I'm looking at the formation of nonprofits, and honestly, my head is spinning.
Okay, that's why we need a roadmap. Let's pull up our agenda and look at what we're going to cover. We should dive into the 4 major trouble areas.
We've got forms and deadlines, financial mismanagement, governance failures, and documentation gaps. I thought running a charity was just about doing good deeds and hosting bake sales.
Doing good is at the heart of it, but compliance is the skeleton that keeps it standing. If you have conflicts of interest or you miss your IRS filing deadlines, the government really doesn't care how many bake sales you had.
So looking at our goals, it looks like we have 3 main missions today. Number 1, identify risks, meaning catching these traps before they snap.
Number 2, understanding requirements. We want to clarify what the IRS and state regulators actually expect from you, so you aren't guessing.
Number 3, implement solutions. We want everyone listening or watching to walk away with actionable strategies for the long term, not just a list of things to be scared of, but actual tools to fix them.
Make sure you stick around to the end. We'll be sharing some of our favorite resources, talking about next steps, and giving you a checklist. When most people think of nonprofits, they picture a weekend car wash or a local Little League. But when you actually look at the numbers, this is a massive industry.
1.5 million registered organizations. That's a lot of 990 tax returns to file.
And they employ roughly 12 million people nationwide. That means the nonprofit sector contributes about 5.4% of the entire U.S. GDP. This isn't just a side hustle economy. It's a fundamental pillar of our country's financial landscape.
That completely changes the perspective. But looking at the statistics from the National Council of Nonprofits, there's a stat that really jumps out. 75% have annual budgets under $500,000. So while the industry as a whole is a giant, the vast majority of these organizations are actually pretty small operations.
That's where the danger lies. Think about it. If you're running a massive state university or a huge international charity with a large budget, you have a whole department of accountants and corporate lawyers to keep you compliant. But if you're in that 75% with a budget under $500K,
You're probably wearing 10 different hats. You're the founder, the fundraiser, the volunteer coordinator, the social media manager, and suddenly the IRS expects you to be a tax professional too.
you just don't have the budget to hire a full-time in-house CFO. And the sector is only growing. The IRS sees 30,000 to 40,000 new applications for tax-exempt status every single year. That is tens of thousands of passionate people jumping into this space annually, many of whom have no idea what they're getting into from a regulatory standpoint.
Which brings us right back to why we are doing this. They have the passion and they have the drive, but we need a roadmap or a checklist so they don't step on compliance landmines. Let's talk about the reality of starting a nonprofit.
The statistics are a little sobering, but we have to look at the hard truth.
12% of nonprofits fail within the first 5 years, and 30% fail within 10 years. That is almost a third of these organizations shutting their doors. Why is that happening?
It comes down to a harsh reality. Passion doesn't pay the bills. People start nonprofits because they have a huge heart for a specific cause, but they often forget that a nonprofit is still a business. If you look at the 4 primary drivers for failure, you'll see a theme. Let's start with an unclear mission or mission creep. Mission creep is when an organization starts stretching beyond its original focused goal. You try to be everything to everyone, and suddenly you're diluting your impact and totally confusing your donors. Plus, you might end up duplicating services of an established charity down the street that is already doing better.
If you dilute the mission, you dilute the money, which brings us to insufficient funding. If you're over relying on a single revenue source, it could jeopardize you keeping the lights on.
If one donor has a bad year or a pandemic hits and your event is canceled, you're done. You have to diversify, and that ties directly into poor management. Scott, how many times have you seen a nonprofit with a board of directors that exists only on paper?
Oh, all the time. They just put their friends on the board, but nobody is actually overseeing the finances or doing any succession planning.
Right. A weak board oversight and a lack of basic business skills will sink a charity fast.
But let's talk about another one, compliance failures. Do you mean to tell me an organization can just lose its tax exempt status?
In a heartbeat, regulatory negligence is a silent killer. If you don't file your Form 990 correctly or you miss deadlines for 3 consecutive years, the IRS will automatically revoke your tax exempt status. It's called auto revocation, and it is a nightmare to fix.
But it can be fixed.
Yes, but it will take a lot of time and a lot of funding to fix. Here at Alpha, we often fix these kind of issues.
So you can have a crystal clear mission, great management, and plenty of funding, but if you mess up the tax forms or have governance gaps, the IRS can just pull the plug.
That's exactly right. You can't out fundraise bad compliance. And that brings us to the actual mechanics of how to get this right from day one.
So to avoid the auto revocation you just mentioned, we need to build this thing right from the ground up. And I have to admit, before I started my EA courses, I thought you just mailed a letter to the IRS, said, I'm a charity, and asked nicely.
If it was only that simple, the biggest misconception is that you start with the IRS. You don't. You actually start locally. Step 1 is state incorporation.
So first up is filing the articles of incorporation. This is the birth certificate of the organization.
You file this with your state to officially exist as a legal entity. But every single state has different rules, forms, and fees. Our home state of Colorado has its own process, but then you look at a state like New York and they do their articles a little differently. Some states have very specific language requirements, and sometimes they even need approval from other state departments before you can even file.
Which is why you don't just want to wing it. Using a form you found online may seem easy, but it really pays to know someone who actually knows how to set it up correctly across those different states. It saves you so much time and money in the long run just to get it right the first time. Next, a nonprofit needs a set of bylaws. This is the internal rule book.
Yes, it's your operating manual. It dictates how decisions are made, how board members are elected, and most importantly, how conflicts are resolved. Do not skip this step, or as you said, just copy and paste one from the internet without reading it.
The next point is to recruit a board of directors. It is recommended minimum of 3 unrelated individuals. So if I start a nonprofit, I can't just put you or my brother on the board and call it a day.
Yes and no. The IRS wants public charities to be governed by the public, not controlled by a single family's Thanksgiving dinner table. So, 3 unrelated individuals is the standard best practice to maintain that public charity status. However, as long as the board is 51% unrelated individuals, this is also accepted. Keep in mind that some states require 4 and even 5 board members.
So that would mean if you have a board of 5, 2 of them could be related.
Right.
So now we cross the street to the federal government.
The first thing you do here is get your EIN, your employer identification number. Think of it like a social security number for the organization. You use Form SS4 for this, and you absolutely need it to open a bank account or file taxes.
We've dealt with the easier steps, but now for another hurdle, applying for 501c status. We have to file Form 1023 or shorter Form 1023EZ for simpler organizations.
Keep in mind the IRS famously has a significant backlog, especially with the more complex 1023 forms.
When dealing with the IRS, patience is definitely a requirement. So while we wait for approval letter in the mail, what are the actual rules we have to start following? Because I hear a lot of founders say, well, we aren't officially approved yet, so we can just figure out the paperwork as we go.
And that leads us to the common startup misconceptions. People tell themselves these little lies to avoid the boring administrative work. But the first one, figuring it out as we go, is a massive trap. You cannot operate, raise money, or hold events while waiting for your 501c status. You have to wait.
What about we're too small to worry about compliance? Going back to our earlier stat, 75% of nonprofits have budgets under $500K. I can completely see why a local charity with a $50,000 budget thinks they are flying under the IRS radar.
The IRS radar is incredibly sensitive. In fact, small organizations often face a disproportionate risk precisely because they don't have a compliance infrastructure in place. A $10,000 IRS penalty is a slap on the wrist for a giant hospital that will absolutely bankrupt a small community theater.
All right, misconception number 3. If we have a good mission, the rest will take care of itself.
Passion is wonderful, but a good mission does not give you a free pass on basic accounting principles.
How about we don't need professional advice? Many people get in trouble this way, and I take it personally offensive. I'm doing practice EA exams at midnight for a reason.
People think they can just Google their way through federal tax law, but this ties right into a reality check. Compliance begins on day 1. I always tell my clients, delaying compliance creates a debt that often is more expensive to fix later than to address it immediately.
In other words, if you aren't in compliance, you could be writing checks you can't cash.
It works just like a high-interest credit card. If you ignore your record keeping, mix your funds, or fail to file the right forms in year 1, the cost in accounting fees, legal fees, and IRS penalties to untangle that mess in year 3 is going to be incredibly expensive. It's always cheaper to build it right than to fix it later.
So let's say we bought into the fact that we need to be compliant on day 1. Let's look at the first major trouble area that gets people into this compliance debt. I have to ask the big question, why do so many well-intentioned organizations find themselves in trouble? I mean, these are people trying to feed the hungry, rescue animals, or support the arts. They aren't trying to run a cartel.
No, they aren't. And honestly, that's the most heartbreaking part of my job. When I see a nonprofit get hit with penalties or lose their status, it's rarely about bad intent. It's almost always about execution.
So it's not that they're trying to cheat the IRS, they just don't know the rules of the game.
Exactly. Which brings us to the first root cause, lack of knowledge. They step up to solve a problem in their community, but they are completely unaware of the complex regulatory landscape required to maintain that tax-exempt status. And because they don't know the landscape, they don't set up the right tools. That leads us right into the root cause number 2, inadequate systems. They're missing the internal controls and accounting framework needed to track their funds properly.
Let me guess, running a charity out of a literal shoebox full of receipts, or maybe a really messy Excel spreadsheet from 2014.
A shoebox is not an accounting system, Scott, but yes, I see it all the time. Nonprofits often get grants or donations that are restricted for specific uses. If you don't have an actual system in place, you end up mixing restricted funds with general operating funds in one checking account. And that is a massive compliance red flag. I suggest using bookkeeping software like Xero or something other than a shoebox.
But setting up those systems take time and money, which leads us to the final root cause: insufficient resources. Neglecting to adequately fund administrative infrastructure and expert advice.
This is the toughest hurdle for founders to get over. They want every single penny to go directly to the mission. It is an incredibly noble mindset, but it's dangerous. If you don't invest a little bit of your budget into proper accounting software and professional guidance, there won't be an organization left to carry out the mission.
It's like the safety briefing on an airplane. You have to put your own oxygen mask on first before assisting others. If the nonprofit itself suffocates from bad compliance, the mission dies with it.
That's a perfect way to put it. You have to keep the organization breathing. So let's talk about the specific traps that usually cut off oxygen supply.
When I first read about the 3-strike rule in my study materials, it gave me a mini heart attack.
Yes, the 3-year rule. It's the IRS's version of baseball, but the stakes are much, much higher.
Looking at the timeline, strike 1 is missing your first year, strike 2, another misfiling for the second year, and strike 3, am I reading this right? No warning sent?
That's the part that catches everyone off guard. If you miss that third consecutive annual filing, the IRS computer system triggers an automatic revocation. You do not get a courtesy phone call. You do not get a warning letter in the mail saying, hey, please fix this before Friday. It just happens.
The rule is completely unforgiving, but how does an organization just forget to file for 3 years?
It happens more often than you think, especially with volunteer boards. The founder assumes the treasurer filed the report, the treasurer steps down and assumes the new president filed it, or they think they are too small to file, which is a huge mistake because even the smallest nonprofits have to file at least a 990N. Before they know it, 3 years have vanished, and so has their tax exempt status.
Which brings us to the alarming statistic: over 100,000 organizations each year have lost their tax exempt status this way.
It's a staggering number, and getting that status reinstated is a long, expensive, and painful process. You basically have to start from scratch and pay all the application fees again. And in the meantime, your donors cannot take tax deductions for their contributions. It's a nightmare.
So I guarantee at least a few people listening right now are having their own mini heart attacks, wondering if they missed a filing. How do they check?
The IRS has a database called the Tax Exempt Organization Search Tool. You can go to that link, type in your organization's EIN, and verify your filing compliance and your current status.
Write down this link and check your status after the webinar. What's the next trap we need to look out for?
It's all about prevention. It's basic housekeeping. Set calendar reminders, keep your address updated with the IRS, and most importantly, file even if you make under $50,000.
Wait, I thought small charities didn't have to file.
Nobody is exempt. If your budget is under $50,000, file a 990N. It takes 5 minutes online. But if you ignore that 5-minute task for 3 years, you lose your entire tax exempt status. Honestly, the easiest prevention strategy is to just partner with an accounting pro like us to handle the deadlines for you.
But let's say the worst has happened. What if someone listening checks their status today and see they've already been revoked?
You basically have to start from scratch. You reapply, pay the IRS application fees again, and wait 3 to 6 months. But there is one lifeline, a retroactive reinstatement. If you reapply within 15 months of being revoked, the IRS can reinstate it like it never happened.
But there's a massive catch while you're waiting, right?
Exactly. While you are revoked, donations are not tax deductible. Imagine telling your biggest donor that they can't write off their $10,000 check this year because you forgot to file a 5-minute form 3 years ago. It will halt your fundraising in its tracks.
Okay, so ignoring deadlines is a huge trap. We know we have to file, but I'm looking at this alphabet soup of forms 990N, EZ, the full 990. How do I know which one to pick? I think I might have messed up the math symbols.
I was going to let that slide, but since you brought it up, yes, your greater than and equal than signs are backwards. But the rules themselves are actually very straightforward. It's all based on your gross receipts and total assets.
All right, let's correct the record for everyone listening. For small organizations, if your gross receipts are under 50,000, ignore the sign on the screen. You file the 990N we talked about earlier.
Then as you grow, if your gross receipts are under 200,000 and your total assets are under 500,000, you graduate to the mid-size category. That is the 990EZ. It's a short form, longer than a postcard, but not a full novel.
And if we hit the big leagues, meaning we have over 200K in receipts or over 500K in assets, we have to file the massive comprehensive full 990.
You got it. But Scott, look on the right side of the screen. What happens if your charity starts selling t-shirts online or selling advertising space in your monthly newsletter?
That's where 90T comes in, UBI, or unrelated business income. So if we make money doing a trade or business that isn't substantially related to our main charitable mission, the IRS suddenly cares?
They care very much. If you make $1,000 or more in gross unrelated business income, you have to file a 990T in addition to your regular return. And guess what? That UBI is taxable.
So a tax exempt charity can actually owe income taxes. I feel like that blows people's minds.
It really does. People think nonprofit means no taxes ever. But if you start making a lot of UBI, it can actually threaten your entire tax exempt status. The IRS will say, are you a charity or are you a t-shirt business?
Which brings us to our pro tip at the bottom. For significant UBI, consider creating a for-profit subsidiary.
If your side hustle gets too big and starts generating too much revenue, we usually advise clients to spin it off into a totally separate for-profit business to protect the nonprofit's exempt status. Keep the mission money and the business money completely separate. It's very complex, so it may be another webinar.
All right, so we know exactly which alphabet soup form we need to file, but now for the golden question. So when do we actually have to file it? I'm looking at the regulations. Instead of just giving us a date, the IRS gave us a math word problem. The 15th day of the 5th month following the end of the organization's fiscal year.
The IRS does love making things sound complicated, but it's actually a very steady rule. Most nonprofits operate on a standard calendar year ending on December 31st. So if you count forward 5 months, your deadline is May 15th.
Okay, so May 15th. But what if a nonprofit operates on a different fiscal year, like a school booster club that runs July through June?
Okay, if your fiscal year ends August 31st, you just do the math. 5 months later makes your filing deadline January 15th. And remember, that deadline applies to all the forms we just talked about. the 990, the EZ, the N, and the T.
What if May 15th is rolling around and our bookkeeper quit, the dog ate our receipts, and we just aren't ready? Can we get an extension?
You can. You are not trapped. You can file Form 8868 before your original due date to get an automatic 6-month extension. So that May 15th deadline stretches all the way to November 15th.
But wait, there is a little caveat listed here. The 990N, it says it cannot be extended.
That's right. That's because the 990N is so simple, the IRS doesn't grant extensions for it. However, there is a silver lining. They also don't charge penalties if you file the 990N late. But remember the 3-year rule. You still do have to file.
Okay, so no financial penalties for the tiny guys, but everyone else filing the bigger forms, are there penalties for late filing? Am I reading this right? Up to $12,000 for smaller organizations and up to $60,000 for larger ones, just for being late.
You're reading that right. The IRS does not mess around with nonprofit reporting. The fines rack up daily. If you are a larger organization, they can hit you with fines of up to $60,000 per year. And remember, if you ignore it completely, you aren't just paying fines, you trigger that dreaded 3-year automatic revocation we talked about earlier.
Which leads us perfectly into staying compliant is significantly easier and cheaper than reinstatement.
Paying an accounting professional to handle these deadlines, file the extensions, and do the math for you is a drop in the bucket compared to a $12,000 IRS penalty or losing your tax-exempt status entirely.
Absolutely. Don't let a calendar date be the reason your charity shuts down. So we've terrified everyone into filing on time, but beating the deadline is only half the battle.
Remember, a nonprofit is a public entity. Anyone can go online and look at your 990. Donors use it, grant makers use it, and of course the IRS uses it. So if it's riddled with errors, you have a huge problem. Let's look at common errors.
Starting with inconsistent information. Discrepancies between part 1 and detailed schedules. So basically, the summary page says one thing, but the detailed math on the back says something completely different.
Yes, the numbers have to tell the same story throughout the entire document. And that leads right into math errors. It sounds simple, but simple calculations mistakes are one of the most common reasons the IRS kicks the return back. Their computers automatically check the math, and if column A and B don't add up to column C, it will trigger an automatic notice.
What about the third one? Incorrect categorization. Misclassifying expenses between program services versus management fundraising. Why does the IRS care which bucket the expense goes into as long as it's accounted for?
Because of the donors. Donors want to know that their money is actually going to the mission and program services, and not just paying for administrative overhead or fancy fundraising galas. The IRS watches this ratio very closely to make sure that the charity is operating for public benefit.
Pivoting to audit red flags. Number one is unusually high compensation. So I can't start a charity, raise $500,000 and pay myself $450,000.
Absolutely not. And if you try, the IRS will come knocking very quickly. Salaries have to be reasonable and proportionate to the organization's budget and peer organizations.
Makes sense. Next is significant losses and inconsistent patterns. So if a charity is bleeding money year after year, or suddenly their revenue drops by 80% with no explanation, the IRS gets suspicious?
Persistent deficits make the IRS wonder if the organization is actually viable or if it's just a hobby that's losing money. And drastic swings in revenue and expenses just look like sloppy bookkeeping, or worse, fraud.
Which brings us to reality check. It says you must provide a complete copy of the Form 990 to the full voting board before filing.
This is a critical governance step. In fact, the 990 explicitly asks if the board was provided a copy before it was filed. The board members have a fiduciary duty. They need to review it, note any inconsistencies, and document that review in their meeting minutes before we submit it to the IRS.
So the board can't just rubber stamp it and say the accountant handled it.
Nope, they are ultimately legally responsible for the organization, so they need to read it. Keep in mind this adds time to the process. The accountant needs time to complete the return, and it has to be submitted to the board, approved, then filed. If the return is ready, but the board doesn't have a meeting for 3 months, you might have a problem to get it filed on time.
We've talked about forms, we've talked about deadlines, and we've talked about math errors. I think it's time we move to the next major trouble area. What happens when people leave or the charity moves?
The IRS needs to know who is in charge and where to find you. That is where Form 8822B comes in. You need to file it for 2 major reasons. First is to change the responsible party.
So if we hire a new executive director or elect a new board president or a new treasurer takes over the books, we have to tell the IRS?
No, only if you elect a new board president. The responsible party is the person who ultimately has the authority and control over the organization's funds and assets. If the IRS has a question or if there's an issue with the tax return, they need to know exactly whose door to knock on. Changes in other board members are on the tax return itself.
So don't leave the old president's name on the file if they moved to Florida 3 years ago. The second reason to file 8822-B is change of address. This seems pretty self-explanatory.
It is self-explanatory, but you would be amazed at how many organizations just forget to do it. They update their website, they tell their donors, but they completely forget to tell the federal government.
The IRS sends audit letters, revocation notices, and all critical correspondence to your address of record.
Right. If you move and don't file the 8822B, the IRS is still mailing those critical time-sensitive letters to your old empty office building. And we didn't get the mail is not an excuse the IRS accepts for missing a deadline. You only have 60 days to file this form after a change happens. 60 days goes by in the blink of an eye when you are onboarding a new executive director or moving an entire office. It gets pushed to the bottom of the to-do list, and before you know it, you are out of compliance.
So moral of the story, when in doubt, fill it out and do it fast. All right, we've thoroughly covered the forms and deadlines, but getting the paperwork in on time doesn't mean much if the money itself is a mess. Let's dive into the trouble area, number 2, financial.
This is where things get very ugly very quickly. When you mishandle the money, you aren't just angering the IRS, you are breaking the trust of your donors.
Looking at the common financial pitfalls, the first one is mixing funds. It creates a risk of piercing the corporate veil. Mom, I'm studying tax, not attending Hogwarts. What does this mean?
It sounds mystical, but it's actually a legitimate nightmare. When you incorporate a nonprofit, the state creates a veil of liability protection between the organization and the individual board members. But if a founder starts using the charity's debit card to pay their personal cell phone bill, or mixes personal and charity funds in one checking account,
The court pierces the veil, and suddenly the founder is personally on the hook for the organization's liabilities.
never ever mix the money. Keep a strict boundary, which brings us to the next pitfall, lack of internal controls.
Wouldn't this be errors, fraud, and embezzlement? Those are heavy words for a charity. It's hard to imagine someone stealing from the puppy rescue.
It is hard to imagine, but it happens all the time. Usually it starts small. If you have only one person opening the mail, depositing the donation checks, paying the bills, and reconciling the bank account, that's a massive lack of internal controls. You must have a segregation of duties, meaning checks and balances, to protect the organization and to protect the volunteers themselves from false accusations.
We already know about the IRS penalties and the loss of tax exempt status, but the third one, criminal charges, handcuffs, are we talking actual jail time here?
Absolutely. State attorney generals take charitable fraud incredibly seriously. If you mismanage public funds, the state can issue a cease and desist order, meaning you are legally barred from asking for another dime. And if it's embezzlement, yes, people go to jail.
Even if you manage to avoid handcuffs, that last consequence, reputation damage, is a total death sentence for a charity. Financial integrity is the bedrock of a public trust. Without it, the mission fails. Basically, you can't ask people to pour water into a leaky bucket.
Precisely. So we have to patch those holes, and the best way that we have to do that is proper governance and oversight. Which brings us to our next major trouble area.
Trouble area number 3, governance failures.
This area is all about the board's decision making or lack thereof. You can have perfect bookkeeping, but if the leadership is asleep at the wheel, the whole ship goes down.
Let's look at the common pitfalls. Number 1, ignoring conflict of interest policies.
It's exactly that. Having a conflict of interest policy sitting in a dusty binder on a shelf isn't enough. You have to actually enforce it. If a board member stands to financially benefit from a transaction, they have to disclose it. And they have to leave the room when the vote happens.
Pitfall number 2, state registration failures. And actually, want to jump straight down to federal exemptions does not automatically grant state exemption.
This is actually one of the most common traps in the industry. A founder gets their 501c3 approval letter from the IRS. They pop the champagne and they think they are done. But to actively ask people for money in a state, you usually have to file a charitable solicitation registration with that specific state's attorney general or secretary of state.
So wait, if our charity is based in Colorado, but we have a donate now button on our website and people from all 50 states are donating,
You might have to register in 40 something different states. And every single state has a different form, a different fee, and a different deadline. It's a massive compliance hurdle.
that sounds like a total paperwork nightmare. The last pitfall, improper political activity, engaging in prohibited campaign interventions. So if it's an election year, our puppy rescue cannot put a sign in the window endorsing a candidate for mayor.
Absolutely not. As a 501c public charity, you are strictly prohibited from participating in intervening in any political campaign on behalf of or in opposition to any candidate for public office.
Which brings us to the fallout. We've already talked about the IRS penalties, losing public trust, and state cease and desist orders stopping your fundraising. But that last one, personal liability. Directors can be personally sued for negligence.
Yes, if the board ignores conflicts of interest or lets the charity operate out of compliance until it gets shut down, they have breached their fiduciary duty. Donors or even the state attorney general can hold these directors personally liable for that negligence.
You know, Mom, being on a nonprofit board is starting to sound absolutely terrifying.
It shouldn't be terrifying, but it is a serious responsibility. You cannot treat a board seat like a country club membership where you just show up for the free lunch. You have to do the work, or you have to hire professionals to help you do the work.
We have one final major trouble area to get through. Let's talk about paper trail. We've covered a lot, but now let's talk about record retention. And Mom, it looks like some things just never go away.
In the accounting world, forever is a very real timeline. Let's look at the permanent records. These are the items you should keep in a fireproof safe or at the very least a very secure digital cloud.
So we keep the articles of incorporation in the bylaws. Those are the birth certificates we talked about earlier. But board meeting minutes, you want us to keep every single set of notes from every single meeting forever.
Absolutely. The minutes are the official legal record of the board's decision. If the IRS or a state agency ever questions why a certain amount of money was spent or why a conflict of interest was allowed, those minutes are your primary defense. If you don't have the minutes, it's like the decision never happened. You need to have a board meeting and therefore minutes at least once a year.
And of course, the IRS determination letter. You're going to need that every time you open a bank account or apply for a grant, so don't lose the original.
Now for the non-permanent stuff.
Keep most financial and legal documents 3 to 7 years. Why the range? Why not just 7 years and be safe?
Well, 3 years is the standard IRS audit window, but certain things like employment tax records or big asset purchases require a longer look back. But if they suspect fraud, they can go back 7 years. So, when in doubt, keep it for 7 years. After 7 years, you can usually start the shredder. However, for assets, it's 7 years after selling, not buying. So, I normally say 10 years just because it's easier to keep track of.
Now let's talk about digital best practices, the 3-2-1 rule for secure backup.
3 copies of your data on 2 different types of media, like a hard drive or the cloud, and one of those copies being off-site. If your office floods or the computer dies, the 3-2-1 rule ensures your nonprofit mission doesn't die with the hardware.
And I love the access protocols point. Define who has admin rights versus view only. This goes to internal controls. You don't want the new volunteer accidentally hitting delete on the 7 years of bookkeeping.
And with data loss protection, you have to be vigilant against malware and ransomware. Nonprofits are a huge target for hackers because they often have soft security. Protect your data like you protect your donations. Now we have one final piece of the documentation puzzle. What happens when leadership changes and the box of papers goes missing?
So we've got the secure cloud backups and the 3-2-1 rule. But what happens when the person who manages all those digital files decides to retire or worse, leaves on bad terms?
That is the most dangerous time for a nonprofit's compliance. We call it the handover protocol. This is where organizations bleed knowledge.
Number 1, no transition plan. Knowledge leaves with the person. This is the classic it's all in the treasurer's head scenario.
If the passwords, the filing deadlines, and the bank access are only in one person's brain and they leave, you are essentially starting from scratch. And that leads to the second failure. Departing executive takes the records.
Wait, people actually take the files with them?
It happens more than you'd think. Sometimes they feel like they own the work because they put so much blood, sweat, and tears into it. But legally, those records belong to the organization, not the individual. If they walk out the door with the donor list and the payroll records, they are putting the nonprofit in a tailspin.
That also goes for the founder who decides to leave, does not own the nonprofit. And even if they leave them behind, you have the third problem: incomplete files, disorganized folders, or password locked digital assets.
There is nothing more frustrating than having a tax deadline tomorrow and not knowing the password to the accounting software. This is why you need the essential documents inventory.
This is the checklist of what must be in the master file at all times. We've got our bylaws, our meeting minutes, and our tax filings, but also donor records and employee and payroll records.
Yes, you have to maintain donor history for audits and relationship management, and payroll records are a huge requirement. This is where we come in. We act as the permanent memory for our clients. Board members may come and go, but Alpha Omega stays, keeping those records organized and accessible across generations of leadership.
The permanent memory. I like that. It's like an external hard drive for your organization's brain.
Precisely. Well, Scott, I think we've officially covered the pitfalls.
My brain is definitely full, but I feel a lot better now. I think we've effectively terrified everyone into getting their files in order and answer some of the common questions. And yes, I see my typo on my slide.
We'll call them common questions because they come into our office every single day. Let's start on the top. Does our organization need an EIN?
People think if they don't have employees, they don't need an employee identification number.
This is a huge myth. Your EIN is your organization's unique tax identity. It's like a social security number for the nonprofit. You cannot open a bank account, file your 990s, or even receive most grants without one.
What if we've lost it? Where do I find our EIN?
First, check your IRS determination letter. If that's missing, look at prior Form 990s, bank statements, or even your state registration paperwork. If you're really stuck, you can call the IRS directly, but you have to be the responsible party or have a power of attorney. Just be prepared to wait on hold for a while.
Now let's talk about a term that keeps popping up. Who is the responsible party?
This is the person who is in ultimate control. It's usually the board president or the founder. When you're setting up the EIN, the IRS requires the Social Security number or ITIN of that specific person. They want to know exactly who is steering the ship.
If that steering person changes, you have a critical deadline. You have to file a Form 8822-B within 60 days to let the IRS know who the new responsible party is.
Don't let the IRS keep looking for someone who retired 3 years ago. Finally, let's talk about the W-9 address. This causes so much confusion during tax season.
We have a principal office address where work actually happens and a mailing address for boring stuff like bills and IRS notices. Which one goes on the W-9?
You can use either. Consistency is everything. If you use one address on your 990 but a different one on your W-9, you're creating a matching error in the IRS system. Pick one, ideally your official mailing address, and use it on every single official document.
Every state is different. Whether you're in Colorado, New York, New Hampshire, these local networks have training, workshops, and compliance checklists specifically for your neck of the woods. Also, online resources.
Sometimes the best advice comes from another nonprofit leader who just went through the exact same audit or transition that you're facing. You have irs.gov/charities, which is the authoritative source for every form we've talked about today. Then there's Candid, which used to be the Foundation Center. If you want data on grants or want to see how other nonprofits are staying transparent, this is the place to go.
And finally, the National Council of Nonprofits. All right, we've got the map, we've got the resources, and now we have the official Alpha Omega action plan. Mom, if everyone is feeling a bit overwhelmed by everything we've covered today, where is the first place they should start?
Well, pillar number 1 is the compliance calendar. You have to schedule the unfun stuff, just like you schedule your big gala or your program launches.
Right, don't just hope you remember May 15th. Get those annual filing deadlines for your 990s and state renewals into your digital calendar with plenty of alerts. And I love the point about board meeting schedules. If you don't plan these quarterly or at least annually, governance tends to just slip through the cracks.
It does. And you need those meetings to hit pillar number 2, board education. We've spent a lot of time today talking about how scary it is to be a board member, but knowledge is the cure for that fear.
And as G.I. Joe says, knowing is half the battle. If you provide clear role descriptions, every member knows exactly what their fiduciary duty actually looks like. It's not a mystery anymore. If you practice financial oversight, teaching them how to actually read the reports, they become an asset to the organization instead of just a rubber stamp.
Make it a standard part of your yearly board retreat. And finally, the third pillar, which is my personal favorite, professional support.
This is the don't try this at home section. Hire the pros.
Well, you can try some of it at home, but for the complex stuff, you need a specialized accountant. Someone like us who actually understands the weird world of nonprofit tax. You need a legal counsel for those bylaws and maybe an expert consultant for the grant writing.
It's all about building a success team. You handle the mission and let the experts handle the guardrails.
That's the dream, Scott. When the guardrails are strong, the organization can go as fast as it wants towards its goal.
That officially wraps up our deep dive into nonprofit compliance. Mom, thanks for being here and being the best study partner for a future enrolled agent.
Anytime, Scott, and I'm very proud of the work you're doing.
Thank you all for listening. If you have questions or you're ready to start building your success team, our contact info is on the screen. Please make sure to download the Alpha Omega Action Plan and schedule an appointment if you have any questions. If you posted a question in the chat that didn't get answered during the webinar, we will be reviewing them and get back to you soon. This is the first in a series for nonprofits. We will also be diving into bookkeeping using Xero, bookkeeping using Excel, and continue conversation on the 990T. If you would like a discussion of other series, you can contact us at info@alphaomega-acct.biz. I'm Scott Knock with Alpha Omega Accounting and lighting your way to financial understanding. Let's keep those missions moving forward.